fundsupermart.com.
Hi Gregor, at Fidelity, what is the technical approach towards fixed income investing?
Well, if we look at tactical positioning, obviously as we go through the credit cycle and we go through the interest rate cycle, we're looking for where we can get the best opportunities. As a firm, we're focused on a multi-strategy approach, and that means that at different points in the cycle, there's different areas which will contribute more value to a portfolio. Now, if we look where we are just now, I think one of the tactical themes that a lot of investors are adopting is to look at where they can get income. In this environment of very low interest rates, many investors are looking for where they can supplement their income by moving into different asset classes. Most notably, we've seen big flows over the last few years into the high yield market. But tactical also means a bit about risk protection as well, and that means that we are seeing investors who are concerned about when interest rates start to pick up, and as a result of that are focusing their investments on the shorter duration end of the spectrum. Now, as it happens, somewhere like high yield ticks both those boxes. It provides a decent level of income, and it's also quite a short duration asset class. So as we see investors who came through the end of last year and were concerned about interest rates moving up, they've actually benefited in the first half of 2014, as we've seen the Treasury come down from around 3% to around 2.5%. It's a bit up from there just now. And that's meant that long duration asset class have actually benefited in the face of what investors thought might work against them. But I think from this point on, we're going to see more investors who are considering duration as a potential negative on their investment going forward and looking for shorter duration asset classes. And as I say, something like the high yield space fits neatly within that. And particularly if we look just now, those low rates also mean that the risk of defaults is somewhat limited as well. So tactically positioning just now portfolios, you will see a number of portfolios who've got decent credit positions and are also quite supportive in high yield.
Within the fixed income classes, where do you see attractive sources of duration and why?
Well, attractive sources of duration, again, I think the theme just now has to be investors looking for protection against the negative impacts of duration. So just to recap, duration is something which has an impact on your portfolio in fixed income as you see yields move for whatever reason. So if you are long duration, it means you're more exposed to those movements in interest rates, and it has, if interest rates or yields move up, it will have a negative impact on your portfolio. So if we see from investing in corporates, investors who are looking for shorter duration bonds, which won't be subject to the negative impacts of yields moving up or interest rates moving up, which has been the concern for many investors since the taper talk we had towards the middle of last year, 2013, which saw a large sell-off in some of the long duration assets like emerging markets, hard currency emerging markets. I think what we're likely to see at this point is more people focusing on shorter duration instruments and shorter duration asset classes. And even to the extent that we've seen that in some very government-dominated markets, we've seen a preference for some investors looking for inflation protection. Now, inflation protection is traditionally a very long-dated asset class. We've seen some investors who are interested in looking at shorter duration buckets of the inflation-linked universe. So not just to talk about credit as a short duration asset class, and particularly within it something like some of the high yield issuance that there is out there, but investors can also use that approach towards some longer dated asset class by trimming or customizing their universe to a more shorter duration subset of it.
Where should investors look at in search of higher yields?
So in terms of high yields now, it's interesting because the name high yield implies to some investors who've been around a long time, double-digit type yields, and actually those opportunities have all but gone now, given what's happened to the government interest rate environment. So now that we've got yield curves which are very low, it means it's very difficult to get high yield from investing in governments. And indeed, as we've seen over the last few years, that's driven a lot of investors to look into the corporate space. And we've seen particularly the high yield corporate universe see quite a lot of compression in spread as investors have moved into that area. So spread is the additional yield you're getting on top of government the yield you get from governments. But as it's happened now is because government yields have come down so far, investors, even with the spread they're getting for investing into credit and high yield space, that spread has come down quite a lot as well due to demand from investors looking for additional income. Now, this theme is probably one that will continue for some time. If we look, particularly we've seen a lot of interest in the European high yield space because the outlook for interest rates in Europe continues to be very much one of easing. So if we now see the announcements of the ECB heading into negative interest rate type territory in some tools, it means that investors are going to be forced to look for other places, and that could continue to drive more interest into some of those higher yielding asset classes. And returning to the theme that I mentioned before is also that for investors who are also concerned around duration and looking for income, then it means areas in the dollar high yield space like the US high yield market and the Asian high yield market could still see some support from investors who are looking for short duration and income.
Thank you.
You're welcome.